Hello, everybody. This is Bob Plessis. I'm president of All-Star Financial, and I want to welcome you to our All-Star Financial Quarterly Review Second Quarter 2012 webinar entitled Multiple Cans Kick Down a Longer Road. Before we get to the information behind that headline, I want to talk a little bit about Bob's Corner. Bob's Corner is really a focus on questions that people are asking frequently in current events. And one of the things that people have been asking, which is a great question, is why are we underperforming the Dow Jones Industrial Average the last 1, 3, and 5 years? Well, the reason behind that is the Dow is really just all large value stocks, so it's not representative of really the large component of the U.S. today. It was established in 1890s, early 1900s. And it was established to represent what was driving our world at that time. So 30 industrial stocks really made up a huge aspect of our world at that time. Now with 5,000 stock options available, it's a very small piece. And if we look at kind of the fear-driven type of mentality lately, more people are putting money into Dow type of stocks that pay higher dividends than into really the stocks that have better valuation and growth potentials. So over the last 3 years, the Dow has underperformed or outperformed the emerging markets by almost 30%. The last 5 years, it's outperformed the emerging markets by 15%. The biggest number to look at is the last 10 years, the emerging markets has outperformed the Dow by more than 80%. That's including all of those more recent negatives. So keep that in mind when we look at an index relative to your performance. Again, our performance, we want to look at the S&P 500 Global BMI Index, which is a broader market index of the global world that we live in, which represents more of our portfolio because it's just not domestic, it's international. Let's talk about the market overview real quickly. We gave a lot of the returns that we gained in the first quarter back. The European debt concern was there. The U.S. and China engines slowed down. We kicked the can down the road for decisions that would help if we could make them, but we can't, both here domestically and over in Europe. We believe that uncertainty is going to create some type of potential policy error that could disrupt our economy for the long term. We're hoping that doesn't happen. Some of the positives that will help that not to happen is Europe did get their house in order and formed a central bank, which is good. We have our Federal Open Market Committee bank that rules for all banks and manages the money supply. They have 17 countries, and each one of them has their own central bank. So it's no wonder it takes a long time to develop that. So they're going to have one as of the end of this next year. The fiscal cliff in the U.S., which has been a concern, was really overshadowed by the European problems. So I don't know if that's good or bad. The U.S. economy, we believe to remain in a slow growth mode. The GDP represents how fast that economy is growing. It's about 1.9% quarter one, revised down from 2.4. Second quarter estimates believed to be less than that. Consumer spending is also down from 5.1 to 2.9 year over year. Unemployment rate is up from 8.1 to 8.2. Manufacturing's just turned negative. We do have some positives, though, with industrial production positive, capacity utilization still positive, low interest rates helping the housing index climb about 4.6% on a year-over-year basis valuation-wise. When we look at the U.S. economy going forward, we have to really be honest and tell you that it's going to be sluggish at best. We don't have a lot of the answers that we need to at this point to the questions. Consumers are not spending. New jobs obviously aren't there with consumers not spending. Businesses aren't spending. They're actually slowing down. We would have hoped that they would have kind of picked up for consumer spending slowing and government spending slowing, but they have not. They kind of hunkered down with their cash. We do have some positives, though. The commitment to the low interest rates by the Fed through 2014 has created a nice housing activity, which is up. Still the biggest question that we have is the unemployment and the business spending. How long are they going to be kind of hunkering down? When we look at the bond market overall had a great return in the second quarter because of the fear that was going worldwide. it sent interest rates in the U.S. 30-year Treasury down almost a half of 1%, from about 2.75 to 2.76. As such, when interest rates go down, bonds go up. The long Treasury was up 10.24 just in one quarter. Unbelievable. Broad market index, which is short and long-term government bonds, produced a little bit under a 3% rate of return. TIPS, which are inflation protected, at 2%. Munis, 1.8. Credit side of bonds, which we believe still to be the best bet in the world, didn't perform well at 1.39 for high yields. Mortgage backs a little over 1. And global bonds, which we have the bulk of our bond exposure, actually was negative 2.63. Going through the markets around the world, though, we still think that rates are going to stay low, which is good going forward. The flight to quality of the U.S. government bond isn't going to be there this next quarter like it was the last quarter. I just can't believe that interest rates are going to go down another half of 1%. And the reason behind that is that it's just not going to beat inflation, and we'd be running into the same problems that Germany and Japan are having, that their long-term interest rates are less than the inflation rate. So value still in the corporate high yield and the emerging market debt side of the world is where you want to be. We've been saying that now for 3 quarters, and the longer we say it, the closer we are to being right. But again, it's just we didn't believe in our wildest imagination that government bonds would do as well as they've done over the last 3 quarters. Stock market. If we look at the stock market again, negative headlines in Europe sent the market down. There's a risk aversion around the world. Markets are up big in the first quarter before they took a little bit of a hit and then rebounded late in the quarter. We saw large caps up over 3, down over 3, mid caps down almost 5. Small caps about 3.5. So whether it be large, mid, or small, it really didn't matter. Value to growth. Growth underperformed by 4%, or an underperformance at 4% versus a minus 2.3 for the value. Utilities and telecom have more of a dividend play, and they were very positive for the quarter. The cyclicals that did the best the first quarter, the financials, technology, and energy, were down about 6 to 8% this last quarter. So again, it's not something that there's a lot of things that keep going quarter after quarter positive. We're seeing a quarter on and a quarter off. So looking forward, we still have to look at the long-term value and ask ourselves, is it still there? And we believe it is. With interest rates low, inflation low, stock valuations are below historical average. Dividend payouts are rising. Corporate earnings are as good as they've been, although they're slow, but they're flattening out. Still very, very good. We believe that the market will pick up later in the year, depending on what the election does. So, international markets, the European recession really was the driver for all European countries and the surrounding emerging countries of Europe too. We saw Europe down 10.1%, Greece down 18.3%, global ex-USA down 7.6%, which is probably the broadest index. And then of mature countries, and then Japan, obviously a very mature country, was down 6.9%. Emerging markets down almost 9%. So looking forward, we have emerging still as our best buy. Most central banks in Europe have already used up their ammo as far as lowering interest rates. They can't get much lower, but the emerging markets are just now starting to drop interest rates. Emerging markets are still growing, although they're slowing the pace of growth. It's still 2 times the U.S. growth. And they haven't lowered interest rates, and the demographic trend is still there. I mean, the numbers bode very well long-term for the emerging market side of the world. So in summary, I think the best quote I saw this quarter was by a money manager that we use, and he said that there's really no risk-free assets. The question is, which risk do you want? And when you look at valuation of asset classes, valuation of domestic versus international, that always wins the race. In fact, Warren Buffett has always said that long-term fundamentals are what wins the race. Long-term fundamentals are better overseas than the domestic. So we put a little bit of chart together for you here so you understand that. You look at the GDP, which is the growth in these countries. Emerging side of the world is over 5%. on an annualized basis. Europe is at 1 and the U.S. at 2. I'll take 5. Debt to GDP, we have the lowest debt to GDP in the foreign emerging side of the world, where established Europe is about 108 on average, and the U.S. is 70% debt to GDP. A multiple of earnings, stock price-wise, the lower the better. 9 is better than 13.9 and certainly better than 15.8. Dividend yield, 3.43 is better than the other dividend yields, although those are fairly high too. Well, why in the world over the last year would the emerging markets be down 16.5 and the domestic market up 2.77 then? Well, it's all a risk-off equation, and just the risk aversion has totally thrown out value-driven money management. 10-year analyzed returns look very, very good, and that's really what we want you to focus on. The 10-year annualized for emerging markets is over 15%, where developed Europe is just a little bit under 7, and the U.S. is slightly over 6. So again, we would love to thank you for what you've done for us, but remember that short-term policy is really driving the market today, and that we really need to keep our focus on the long-term fundamentals. Thank you for your continued trust in us. Remember our referral program. You do get a reduction in your fees. We had actually 2 new clients come in last quarter just by having one of our clients forward this webinar to them. So we would love if you could do that to a friend or a family member that might be interested in our economic outlook and what we think is going to happen in the market for the next quarter and what happened last quarter. So thank you for your time, and we will look forward to talking to you in our office very soon. As always, give us a call if we can ever do anything for you. Here's our team members, our 9 team members, from start to finish, and we are dedicated to helping you answer your questions. So please give us a call if you need anything. Have a great day.